You know, I had just joined the military in '08 when a lot of the financial chaos was happening during the '08 recession. And so I wasn't really paying attention. I didn't really have a ton of money in the market anyways. I was 21 at the time. But I saw this article on Twitter, and I was thinking, there's a lot of parallels between today. It's a CNN Money article from '08. Okay. And it says here at the top, stocks surge as Fed acts. Remember, I talk about all the time the fact that our stocks are the equities market, all markets really, go up and down based off of Jerome Powell. That alone should tell you we don't live in a free market. And it all kind of started in '08. But you will see so many parallels to today with the banking crisis. And today, I think it's far worse because there's far more leverage in the system. May not play out the exact same, like residential mortgage-backed securities, but we have something else, commercial mortgage-backed securities, right? So it says here in this article, Wall Street rallies as Washington moves to stem the financial crisis. The Dow jumped 780 points in 2 days, best run since 2000. Right? New York, stocks rallied Friday with the Dow. This was September 19th of 2008. They plan to help rescue banks from toxic mortgage debt. It soothes investors. Investors at the end of the gut-churning week on Wall Street. Treasury prices plunged and gold prices tumbled as investors bailed out of the safe haven plays and poured money into equities. Sound familiar? Everyone's waiting for the Fed to do the exact same thing. The big difference today is $32 trillion in debt. That's a big difference. Because our national debt plays a huge part in how much goes into taxes, how much inflation there is, how much redistributing, how much more debt we have to take on as a country. And basically, it just gives you less room to move and pivot as an economy. Okay, all this that was happening back in '08 is fake. It was just a financial band-aid. Because again, you cannot eliminate risk. You can only redistribute it. You can change hands. You can say, hey, bank, sorry about that. Sorry about your stupidity. Yes, somebody has to pay these debts, and that somebody's going to be the taxpayer. So the debt for the banks in '08 went up to the taxpayer to the national level. And it's continued to do that with QE, et cetera. Okay. Friday's session capped off a stunningly volatile week on Wall Street, in which, for example, the Dow daily ricocheting between lows and highs. Volatility. Have you seen that? You've seen it in the treasury market too, which is absolutely insane, which is usually the most stable asset. So the Dow was going up and down. Treasury Secretary Henry Paulson outlined the plan on Friday, saying that it would likely cost hundreds of billions. This is the funny part. Hundreds of billions today is like, that's chump change. It's fiscal dust. It's nothing. So we start using words like trillion, which, if you're wondering, is 1,000 billion. And so the bailouts get more and more behemoth. And the next one is going to be even more behemoth. We're talking $20 trillion, right? So just in '08, it was just billions, hundreds of billions, which anyone in the right mind was like, jaw to the floor. That is a ton of money. And now today, relatively speaking, we're like, hundreds of billions. We hand that out for butterfly gender research. So what's a couple $100 billion? Okay. He said it had to be substantial enough to make maximum impact. And what an impact it made. I'm going to show you the Dow chart here in a second. Remember, too, history repeats, which is hilarious. And it wasn't that long ago. I just wasn't paying attention back then. But short selling ban. In an attempt to limit the plunge of financial stocks, price discovery, the person who says, I was on Nobody Special Finances channel the other day, and we were talking about, hey, they don't want you to yell fire in a crowded theater. But what if there's a fire? That's what short sellers are telling you. There's a fire. Ban it. Ban it. Ban them from saying it. So they banned short selling in an attempt to limit the plunge of financial stocks and securities. for nearly 800 financial stocks. Short selling is a process. Okay, we talked about that. UK did a similar thing. It's just financial engineering, moving the chess pieces around. But guess what? You cannot engineer math. If that makes sense. So they engineer it in such a way without taking into account human beings and incentives. So they go, oh, okay, we'll stem the tide. We'll create this moral hazard forever. They're actually not thinking they're creating a moral hazard. And then the moral hazard comes due. People are like, well, there's free money at the government, like the PPP loans. And they think, well, no one would ever abuse this. Of course not. No bank is going to take more undue risk after 08. Yes, they did. Because they know if they're too big to fail, you'll bail them out. And if they don't do that, as I've said many times, you're a sucker. You're a sucker if you're a bank who doesn't take undue risk, because you will go out of business. Because there's another bank who's just running razor thin margins and giving out loans and all that kind of stuff, and they're making tons of money. And you don't do the same. You do a more stringent risk diagnostic for handing out loans. And if the economy falls apart, you're not rewarded for doing that risk management. You're punished because they're bailed out. So it talks about this. I'm going to link this in the description too. But here's the part that's so interesting. Friday's news seemed to cool fears, giving a boost because they remember they kind of leaked, we might ban short selling again. And then all these bank stocks, these original bank stocks went up. Okay. Gave all the companies that were at the source of the panic. Merrill rose 34% in a day. Bank of America, 23. AIG, 43. Morgan, 21. So all this financial engineering led these companies to rocket up on the stock market. You say, profitable times are here again. Let's forget about all the mismanaged capital and malinvestment in the market. We have gotten rid of all the risk, but unfortunately, no, they hadn't. Because let's take a look at the date on this article again. It was September 19th of 2008. Now let's take a look at the Dow Jones in 2008. Okay. This is when they came in September, right there, and said, uh-oh, we've got this big drop off. We need to stem the tide. Does it look like they stemmed the tide? The market is always going to tell the truth, folks. It may not in the short term. In the long term, it will always tell the truth because it's aggregated millions of people, billions of people operating on their own self-interest. So it'll always tell the truth. So as they came out and said, happy times are here again, not to worry, the Fed is printing money. This is what happened. Another 40% drop, all the way until it bottomed in about February of 2009. So if you were one of those people that, read this article back in 08 and like, happy times are here again, I'm going to go long on all these bank stocks because the Fed's coming in to back them up. There isn't enough money to back up the amount of loans that are out there today without creating inflation. Of course, we can print. Sure. But if you don't tie money to productivity, money's useless. And keep in mind, you saw all those those words that were used in that article. It's like stem the tide, soothe the market, because it's all psychological. And when your average person realizes, the feces are hitting the propeller, this ain't good. And then you see the articles like Jim Cramer will probably be one of them. They'll be like, hey guys, everything's fine. That's when you should run. That's when you know you're about to get dunked on in the market because the fundamentals cannot be ignored. Washington tries to do it. They try for a long time. It just doesn't work because you can't print prosperity, and the market knows it. All the participants know it. And so try to ban short selling, try to ban all this, you try to rig the markets, but at the end of the day, you're not getting more goods and services. Therefore, you're getting poorer. Bottom line. All right, guys, let me know what you think. I'll link that article so you guys can read the whole thing if you want. It is kind of interesting. Like if you look up 08 articles, because like getting in the mind of what people were thinking back then, you're like, oh, this is very similar, except Now we're worse off, way worse. 3 times more national debt, maybe 4 times more national debt, more loans, more commercial real estate, more everything, more leverage. So worse. All right, y'all. See y'all on the next one. Peace.